Hey guys, so let's talk about gaps. So if you are in my school community, you may have seen where I have talked about trades such as Intel. We've traded it. I uploaded trade plans as well as mentioned Oracle. Now, I wanted to mention those two because I want to use them as real life examples of why gaps take place on the market. All right. Now, the very first thing we're going to look at is why does a gap even happen? Let's look at Intel and why Intel had such a massive jump from $24 on up to about $31 overnight. Okay, and when that happened, it resulted in this taking place, which was a gap because the price jumped from one point all the way up to another. The thing that results in gaps is when we chilling. When the market closes at 4 p.m., we're not really buying, we're not putting it in the orders or anything, but not all of us rather, but there are still people who are making moves on the market. Markets are open elsewhere and action is taking place, right? So what's happening is while the market is closed or closed out at one price, there are buyers and sellers still agreeing on other price points. So while we were sleeping and when we woke up in the morning at 9:30 that the market opened, buyers and sellers agreed that they wanted to stop at this price. Meaning, yesterday when the market closed, buyers and sellers was agreeing on a $20 price point. But overnight, they were agreeing on a $25 price point, a $30 price point. So the stock jumps from where it was and it jumps to this higher price point, resulting in this massive gap taking place. And that gap is just showing that there is no price action from $20 to $25 or $30. It just jumped up. So it didn't go from 20 to 21, 21.50, 21.75. It went from 20 hypothetically on up to whatever that higher price is. And that's exactly what took place with Intel and Oracle. And what resulted in that was the news, right? Intel, NVIDIA has invested $5 billion to take a stake in Intel. That news resulted in the price jumping because buyers and sellers was agreeing that Intel may be worth a little bit more than what it was when the market closed. So we're going to agree on this price. So when the market opens, the stock has jumped up, leaving this massive gap of no price action. That right there could be one of those things that results in gaps showing up. Another thing could be earnings. Overnight, let's just say a company reports their earnings after the market closed instead of during. So because it's after the market is closed, a lot of us have no access to do any trading. But we see that buyers and sellers are agreeing on a price after that market has closed, and that price is much higher than it was when it closed. Therefore, a stock could have been $50 and we wake up now it's worth $150. That is a massive gap. And not too often you'll see a gap that massive, but hey, who knows? It happens, and gaps can be big and they could be very small. I look at Oracle. Oracle also have a gap. Now also I want to remind you of something, that even though gaps may show up on like daily time frame, it may show up on hourly, it may not show up on other time frames. It may appear as what we call a fair value gap. You may see this long massive candle and you don't see a gap at all. But if you go to a higher time frame, like I say a daily or a weekly, you may see a really large gap there. So sometimes the gaps can appear much more clearly on other time frames than they will on others. Now the second thing, is this a bullish or a bearish signal? What does this gap tell us to do? Here's the thing, it doesn't tell us to do anything. We have to kind of look at market psychology. What is the ideal thing that the market will likely do if there is a massive gap on the chart? And that is what you will probably see as a gap fill. They're looking to fill the gap before the stock continues to push up. As you were saying, this stock might be bearish because there is a massive gap and the market is likely to refill the gap before they decide to give him any more upside. So I'm probably going to enter into puts. Now, I personally like to say I want to see the gap filled before I go too hard on calls. That does not mean that the stock will not push up some more before the gap is filled, because you never know how long it's going to take for a gap to fill on any stock. It could take weeks. It could take a couple of months, but it won't always fill immediately. So this gap that we're seeing on Intel is actually almost refilled. But the one that we see on Oracle still has some refilling to do, but it does not mean that they're going to fill the entire gap before we see more upside. And that goes back to not seeing this massive gap on other time frames. So you may react to what you see on a lower time frame versus a higher one that is showing the gap. So how do you trade it? You just trade it accordingly. You watch the charts and react to what you see. I just say don't go too hard because you want to kind of pay attention to what may take place with this gap there. Look at older gaps. Go further to the left of your chart and kind of get an idea of how the stock moves when gaps took place. How long did it take for the last massive gap to fill? What did the stock move like when it had such a large gap? What were some things that took place? You can see all of this to the left of your charts by simply going further back and trying to spot gaps and see just what it looked like when it was filled to kind of give you an idea of how you want to go about your move, especially if it's a long-term one. When you see gaps on your chart, this is just what it means. It just means that the price continued pumping. Price points or price action was sort of skipped over. It pushed up a little bit higher, and it's not really a bullish or a bearish sentiment, okay, or a signal. It's just something to pay attention to because the market does have its way of refilling gaps before things continue to move forward. But that does not mean it will happen quickly or there's really no sense of how long it's going to take. You just have to react to what you see on the charts and you plan your trades accordingly. I hope this gives you a better understanding of what gaps are. This is just what you call a common gap. There are different types of gaps. You have exhaustion gaps, you have runway gaps, you have island gaps. Like there are different gaps. But what we're seeing on Intel and Oracle or any other stock are likely just common gaps that took place because of a massive move that took place overnight or just in some time period when the market opened. It was up much further or down much further from where it closed out. All right, so the next time you see a gap, just kind of pay attention to it, look at the range of the gap and make your moves from there, because you probably will see that you could still make short-term moves based on other time frame than from where you may be seeing it. So just plan accordingly, go easy, and just take it into consideration. And with that, I will see you guys in the next one.